Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, March 28th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to see the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start today's key macro event, which is asset markets performed according to our plan in Q1. So the nuance there is that the MSCI All Country World Index is set to rise 8% this quarter, as investors were forced by the data to price in our green shoots globally theme. Refer to the right tail risk section of our March 2024 macro scouting report for our latest deep dive on the subject. Refer to our December 15th and our January 24th leadoff morning notes for our earliest deep dives on the subject. In terms of market implications, the number of investors that know readily available information, like every major economy except Canada has a composite PMI reading that is trending higher, or each of the four largest economies have meaningfully positive economic surprise index values, is embarrassingly low compared to the number of investors that have been free bear porned into expecting a commercial real estate crisis or whatever other macro tourist crisis du jour is hot right now. The relative value of a legitimate, repeatable, quantitative, and probabilistic macro risk management process has seldom been higher than it has been over the past 12 to 15 months. Macro tourism is great for entertainment purposes, but it is not great for you or your client's portfolio. Transitioning to our 42 macro dashboard, we're getting a near overbought signal here in the Russell 2000, getting an oversold signal here in the Shanghai Composite, and then we are getting I want to say it was a near overbought signal in gold there. So just be aware of those tactical trading range signals. These are short-term signals for those who are more active and more high frequency, have a higher frequency portfolio turnover. And then lastly, wrapping up with a question from our community, reads: Recession watch dead or just on hold? So reviewing the question. With growth and inflation surprise to the upside, leading economic indices turning back up, financial conditions continue to ease. Are you still in recession watch based on your likely window of November 2023 to April 2024, or has enough evidence to accumulate it to say this time is different? Right now, no soft landing seem very likely, but I may just be biased by markets versus seeing all of the data, trying to put probabilities on different outcomes. Thank you for your input and hard work. So you're welcome. Appreciate you guys, obviously, for subscribing. It's a labor of love here at 42 Macro from our team. So let me just break down each of these sort of sub questions in order. Are you still in recession watch based on your likely window of November 2023 to April 2024? The answer is yes. You still have to be on recession watch as long as the yield curve is inverted. The reason that likely window of November 2023 to April 2024 came about in the first place, we did a deep dive empirical study back in November of 2022 that said the highest probability 6-month interval that we should expect to see a recession occur based on the timing of the initial inversion of the yield curve was November 2023 to April 2024. That's not to say a recession had to start in that window, but going back and sequencing the historical yield curve inversion and the recycles and then lead ups into recession, we saw that the 13 to 18 month forward window had the highest probability of seeing a contraction in real GDP and a rise in the unemployment rate. And that 13, 18 month forward window from November of the October of 2022 yield curve inversion and 3-month 10-year was November 2023 to April 2024. So that was the window we said had the highest probability of seeing a recession commence. That was not the window we said a recession was going to commence, because we never here at 42 Macro talk about any outcomes that are in the future with certainty, with 100% certainty. It's all about what's the highest probability event, what's the lowest probability, how are those probabilities changing and evolving over time based on the evolution of reported economic data or the evolution of financial market signals vis-a-vis our global macro risk matrix and our other forecast macro risk management tools. So getting back to the question, has enough evidence accumulated to say this time is different? Well, yeah, it's definitely different. I think that when we continue to look at our leading indicators for recession from an economic reporting standpoint, namely our 42 Macro Fab 5 recession signaling indicators, initial jobless claims. We have other leading survey-based data that have give you clean reads on a rising probability of a developing recession. All of those things continue to suggest that the probability of a developing recession is low here in the U.S. economy. So I would say, yes, this time is different because we are moving past the high probability window into the great beyond, into uncharted territory. This will, likely be the longest period of time in history when it's all said and done, from the date of the initial inversion of the 3-month 10-year Treasury yield curve to when a recession actually starts. And in our expectation, a recession is unlikely to actually start anytime soon, again, based on the probability that we are currently deriving from our Bayesian analysis of all the leading indicators of the business cycle. And so, keeping back to the question, right now, no soft landing seem very likely. And just according to our econometric models and according to our qualitative research that we're performing on the economy in terms of connecting all the dots across the various cycles within the economy, a no landing is the highest probability scenario over the next 12 months. So that means we're probably going to be having this conversation a year from now, talking about the recession still hasn't come, which would definitely make it the longest period of time from the date of the initial inversion of the yield curve to the start of a recession. Again, we still think a recession is obviously going to happen. That's what the business cycle does. It does recess, it contracts eventually. But again, expecting a lot of investors were wrong on the timing of that contraction because they're spending too much time on, what, in my opinion, free bear porn, and not enough time in, responding to, the evolution of reported economic data, not enough time responding to the evolution of financial market signals. A lot of investors have buried their heads in the sand with respect to this raging bull market that we've experienced, really for the past 18 months. We participated in it for the past 15 months, and the reality is, you could have just, I don't even want to go down this rabbit hole, but the key takeaway I'm trying to make is, it was there. The bullishness in the market was there. The bullishness in the data was there. And if you were doing your job as an investor, or allowing firms like myself and our team here at 42 Macro to do the job for you, you would have known that it was there. And so, this is the value. This is what I said earlier in the market implications section, just earlier in this macro minute. The value of having a legitimate, repeatable, quantitative, probabilistic macro risk management process has never been higher compared to the low hanging fruit, the low barrier to entry macro tourism that everyone is obviously overdosing on a daily basis. These podcasts are free for a reason. If a product is free, you are the product. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, March 28th, 2024. We're going to be offline tomorrow, so we'll catch back here next Monday. 42 Macro subscribers, we will have our Around the Horn out published tomorrow afternoon after the advent of the February PC report. So be on the lookout for that in your inboxes. Everyone have a wonderful weekend. Catch you back here Monday. Cheers.